Well, thank you very much for the introduction, and thank you to HGCA for the invitation to speak here today. My name is Julian McGill, and I'm from LMC International. I work at our headquarters in Oxford, and I'll be speaking on oilseeds. The broad situation in the oilseeds market will be one with which you're all very familiar. There's too much output and too little demand. I'm going to start by looking at the drivers behind this. And I'm hoping to convince you that the number one factor that explains the position we're in today is the decision by our government and by other Western governments to encourage the use of vegetable oils in biodiesel as transport fuel. The unintended consequences of this policy have been staggering. It's necessitated a huge increase in production of vegetable oils. It's transformed global agriculture from South America to Southeast Asia. And today, as this supply has come online, we're looking at the US and EU slowing their support for biodiesel. And the prices we're looking at are driven to the greatest extent by this dynamic. But with the EU and the US retreating, many of the changes they've made are permanent. And what I'm hoping to convince you is that the way in which the markets now function mean that the oilseeds market is part and parcel of the petroleum complex. But I'm also hoping to convince you that markets react to signals. And as they reacted to the signal from our biodiesel policy, so they are now reacting to the signals given by a retreat. And I'll show you the ways in which we're already seeing adjustments to the markets happening today, which may be surprising, but the markets really are working. I'm going to start with a diagram that, no matter how often I look at it, I always find remarkable. This is the share of vegetable oils used as biofuel. So that's used both as biodiesel and burnt directly to create energy. And if you look at the, I guess it's a greenish line that shows the total oils used as biofuels, first thing you can see is that for a long period we used hardly any. And then in 2005, it begins a rapid increase. By 2007, about 7% of all vegetable oils in the world are being used as biofuel. Today, the latest figures is about 15%. The other thing you'll notice is that we've shown here the different of the major vegetable oils, the shares used by each of them as a biofuel. And the thing that will really stand out is rapeseed oil at the top. The share of rapeseed oil used for biofuel in 2010 peaked at about a third. A third of all rapeseed oil produced in the world was used as biofuels. Now, the reason why rapeseed oil is the most important one here is, of course, that the EU is driving biodiesel policy. The EU still is the largest market for biodiesel, and they favoured rapeseed, both because we produce it and because of its better cold weather properties. But you'll see another point is that the share of rapeseed oil has declined since 2010, but the total share of vegetable oils being used as biofuel hasn't declined, it's continued growing. And as rapeseed oil has retreated, so palm oil has increased. And this is an important point to remember, because this is really going to come back later on in the talk. What has this meant? Well, the increased demand from biofuels has meant that around a quarter of all demand for vegetable oils in the last 14 years or so has been basically for biofuel demand. That's a huge additional demand for vegetable oil. Now, as you'll all know, if you take an oilseed and you crush it, you take soybeans, for example, you get both a meal and an oil. In the case of soybeans, about 80% meal, 20% oil. Now, what we've done here is we've plotted the demand for the meals, vegetable meals, and what we've done is we've converted them into a soy meal equivalent, because they all have different protein content, so we've put them all on the same basis. And we've plotted that on the left-hand axis in green, running up. And then we've looked at the demand for vegetable oil, and we've plotted that on the right-hand axis in blue. And you can see that for the longest period, the two moved in lockstep. But recently, it was about 2005, 2006, vegetable oil demand has been increasing at a much faster rate than meal demand. The cause of this is biodiesel policy, of course. Because biodiesel policy created an additional demand, 25% additional demand for vegetable oil, but no additional demand for meal. So in effect, what it's done is knocked these markets out of kilter. So it's encouraged production. And here we can see, once again, here are the major vegetable oils: crude palm oil, rapeseed oil, soybean oil, sunflower oil. Palm kernel oil is also in there. That comes as a byproduct from the crushing of the kernels in the fresh fruit bunches of crude palm oil. And the point to make is that, yes, production has increased across all of them, but one oil in particular has increased very, very rapidly, and that is crude palm oil. You can see crude palm oil is in the greenish color there, and by about 2005, it dethroned soybean oil as the world's largest vegetable oil. Now, the reason for this increase in crude palm oil production is that palm oil produces around 4 tons of oil a hectare, but produces negligible amounts of meal. In fact, the only meal produced is from crushing the kernels. So it's ideally suited to a world in which the demand for oil is running faster than the demand for meal. So in that way, this biodiesel demand has really pushed a lot of additional demand into palm oil. Now, some of you are going to be saying that I only, on the other graph I showed you, I only showed palm oil demand for biofuels increasing recently. And you'd be quite right. But one point you have to remember when you're talking about the vegetable markets is that they're essentially interlinked. There are some restrictions to do with GM or non-GM, to do with the saturated fats levels, but essentially one vegetable oil can substitute for another. So that when the EU starts its policy on rapeseed oil, putting a third of that into biodiesel, other oils have to come in and meet that place. And it's through this mechanism that palm oil, even when it isn't directly being used as a biodiesel, which it is now, but even when it wasn't, is coming in to replace other oils that have moved over. And this is an important point to remember when we're looking at the prices as well. So what we've plotted here are the prices at Northwest Europe, at Rotterdam, in US dollars per ton for the major vegetable oils. So you'll see palm oil, soy oil, rapeseed oil, sunflower oil. Alongside that, we've plotted the Brent crude price, so the North Sea crude oil price. Now, the first thing you'll notice is prior to 2007, which is when that line is coming down there, there's no real link. In fact, you can see palm oil is actually cheaper than Brent crude for long periods. The oils are moving in a vague hierarchy, depending on their qualities, but they're not particularly linked. Past 2007, something remarkable happens. You're looking here at a price band. Past 2007, the oils seem to move in a band above crude oil, with crude oil as the floor. And you see it's quite striking. Now, why would that be the case? Well, if you recall, 2007 is the point at which about 7% of total vegetable oils in the world are being used as biofuels. And our argument has always been that that was sufficient to start directing the prices. Now, how would this work in practice? Well, if you take the EU's biodiesel mandate, the biodiesel mandate is set as a certain proportion of biodiesel that needs to be blended into diesel over the entire year. It doesn't specify when. So if you're one of the obligated parties who are doing this blending, you are looking at the spread between crude oil and the vegetable oils. And when vegetable oils become relatively cheap compared to crude oil, that's the moment at which you blend. And the diesel market is huge compared to the vegetable oil market. Crude oil is by far the largest traded commodity in the world. And so slight adjustments in that volume of vegetable oils going into biodiesel can really start to direct the vegetable oil market. Conversely, when the vegetable oil prices get too high, you stop blending. You move back, you wait. And in fact, in the EU's case, you could even buy out of your mandate, so you'd stop blending completely. An argument has been that through this mechanism, you have the tail wagging the dog. You have a situation where the biodiesel market is determining the vegetable prices and making them move in this very striking band. Now, that was always an argument we made. And then in 2012, we had an opportunity to test it. The sort of opportunity doesn't come very often to economists. A real-world test. As you can see, the palm oil price in blue, which is usually the lowest priced of the oils, in 2012 started to come down. And it kept coming down until it hit the Brent crude price. It hit what we call the floor of the price band. So what happened at this point? Well, the way we need to look at it, if we're following my argument, is that we need to look at the premium. So how does crude palm oil compare to Brent crude? So what we've done here is we've plotted crude palm oil minus Brent crude, the price premium. And what you can see on the left is the end of 2012. This is the point at which this price is coming crashing down. These are daily prices, by the way. You can see there the price comes crashing down. At one point, at a daily level, the crude palm oil price becomes less than the Brent crude price. But then it bounces back up again. And in fact, on 3 separate occasions now, we've seen exactly this. We've seen the price come down, go to a discount, and then bounce back up again. So what's happening? Well, what's happening is that at that point, palm oil is cheap as a fuel in its own right. Outside of any mandates, outside of any government incentives, it is cheap to simply put biodiesel into diesel. And that's exactly what's happening. At this point, blenders are looking at the market and they're saying, well, we can do this without any government encouragement, we'll just use it. And of course, taking that palm oil supply off the market pushes the prices back up. So the floor of the price band was tested, and it was found to be firm. Now, I've been arguing that the EU and the US are retreating in terms of biodiesel policy, and you may be asking right now, what does that mean for this price band? Is this theory still going to hold? What if the EU and the US decide they don't want any biodiesel whatsoever, they're giving up on it? Well, the truth of the matter is that the world has changed. The knowledge that biodiesel can be used cheaply as a fuel is now out there. And the other thing is that the EU and the US are no longer driving this. If we take the price in Southeast Asia of crude palm oil, so this is the premium of crude palm oil in Southeast Asia over the Brent crude oil price. Now, you may be asking, Brent crude, the oil price in Singapore is approximately the same as Brent crude. In fact, if anything, it's slightly higher. What this is showing you is that because crude palm oil prices are lower in Southeast Asia, you're netting out the freight to the EU, palm oil is actually very cheap there as a feedstock. For long periods, it's been cheaper than diesel. And people have been recognizing this, and they've been blending outside of any government encouragement. The government is now stepping in to start encouraging it, but they've been recognizing this. And the situation is even more extreme if you look inside Indonesia. Indonesia has an export tax on crude palm oil. The export tax varies depending on the tax band, which varies on the base price of CPO. So starting from next month, they may no longer have an export tax because the price is about to go below $7.50. But for most of the period, they've had this export tax, and it's reduced internal prices of crude palm oil, to the point at which if you're inside Indonesia, you might as well be using crude palm oil as a fuel. And that's exactly what's been happening. We've seen it on plantations where they've used it in the boilers as electricity, they've used it in the trucks, which can take a higher blend, and now they're trying to blend it into, they're also encouraging mandated blending, and they're using it to try and reduce their diesel imports. So even with the EU and the US step back, the genie is out of the bottle. The world is now one in which the petroleum and the oilseed markets are linked. So what does this mean for prices? Well, I hope you agree with me that if you are now looking at vegetable oil prices, the very first thing you need to look at is the crude oil price. It is the crude oil price that sets the bottom barrier to the vegetable oil price. But of course, prices aren't always at the floor. So the second point is the premium. At what premium will vegetable oil prices be over Brent crude? And to look at this, we need to look at more traditional measures, and in fact, we need to look at stocks. Now, the stock that is the most important for determining the prices is that of crude palm oil. And the reason for this is that crude palm oil, if you go to an oil palm plantation, it's a perennial crop. It is harvested continuously over the year. These large fresh fruit bunches are harvested, and they need to be moved immediately for processing, because otherwise they get a high free fatty acid content. So you are continuously churning out crude palm oil as an oil palm plantation, and in a sense you're a distressed seller. You're having to move this. Unlike with the seed oils, where you can wait to crush them, you can hang on to them, with crude palm oil, you're looking to move it very quickly. So the stocks of crude palm oil are the most important single determinant of the vegetable oil complex, outside of the Brent crude price. So what we've done here is we've plotted Malaysian Palm Oil Board stocks, which are the only official stocks available, alongside, once again, the crude palm oil premium over Brent. And what you can see here is that there's an inverse relation. And in fact, the period in 2012, and I said when we tested the price band, what you can see is you can see the premium collapsing down, hitting the floor, and then coming back up. And you can see that what was driving that was extraordinarily high stocks of crude palm oil. And in fact, to interlink it all, the high stocks of crude palm oil were the result of the Indonesian export tax, which was moving Indonesia into downstream processed products and causing huge amounts of crude palm oil to build up in Malaysia. And at this point, there were huge concerns over the price of palm oil, what was going to happen. But as we can see, the stocks went up and up and up, and the price hit the floor. It became worthwhile blending outside of the mandates, and it came back up. So generally, if you want to understand the price of vegetable oils, you need to understand the crude oil price, but you also need to look at the premiums, and the premiums are related to the stocks. Now, this doesn't always work, I'll be honest with you. If you look here at January 2013, you can see the price went up, came back down and hit the floor again, but stocks hardly went up. And in fact, what was happening at this point was that the market was forward-looking. People that know this within Southeast Asia, and they were looking towards the stocks, and all the forecasts at that point were for huge excess production and stocks at around 2.5 million tons. In reality, it didn't happen. Prices then recovered. The stocks were not nearly as high. But you can see once again the price floor was tested, and it did not go below crude oil. Now, the reason it didn't happen, what we've got here is year-on-year output growth in crude palm oil. And you can see Q3 2013, the point at which the price once again collapsed. This was meant to be a period of excess production. And in reality, what you can see happened is, so we've got Malaysia and Indonesia here and then the total. You can see that actually production was less than the year before. Production fell far short of forecasts. And it was a result of that we didn't get the build-up in stocks that people expected, that people had forecast. But the central message is the market is looking at these stocks, the market understands how it works, and when it hits parity with crude oil, the prices come back up. Another thing you can see here is that right now production is very good. Crude palm oil, and this is the reason why currently, in the last months, we've seen once again the price floor get tested. But it's not just palm oil prices that have been weak. As you will well know, it's vegetable oil prices across the board. Now, what we've done here is, once again, as always, this is the premium over Brent crude for palm oil in blue. But we've also plotted the other major vegetable oils, rapeseed oil, sun oil, soy oil. And what you can see is that prior to 2013, the soft seed oils, so soy, rape, and sun, were at a premium, at quite a high premium, around $400 to $500 to Brent crude. And there's a number of reasons for that. One of them is that, as I said, you don't have to crush soft seeds. You can hold on to them, so you don't have to deliver it to the market just because it's there. That keeps the premium higher. The other point is that the EU, the US, when they had additional demand for biodiesel, it was demand for biodiesel from soy, from rape. That pushed up the prices. And finally, really, these are premium oils, historically. People prefer rapeseed oil. They'll pay a premium for it. Not anymore. Today, the prices of all these soft oils are right down next to palm. They're being pushed up by palm. Palm, in turn, is being held up by the crude oil price. The price band has flattened. Now, what's caused this? Well, one issue, as I said, is biodiesel. They've retreated on the biodiesel. It's not growing as quickly anymore, so there's not the demand there. But the other issue is production. So what we've plotted here is the main producers of sunflower and rapeseed. In sunflower's case, Ukraine and Russia. In rapeseed's case, Canada, Australia, and ourselves at the EU. And we've plotted alongside that the premium these oils have over crude palm oil. Because in effect, they're pricing themselves into crude palm oil. And the first thing you'll notice is that the premium over crude palm oil varies depending on the level of production. So if you look at 2010, the very good rapeseed harvest, the rapeseed oil premium over palm oil collapsed. When harvests went back down in 2011, it came back up. But the general point is that harvests have increased hugely. Production has reacted to the signals provided and has gone way up. You look at the Ukraine and Russia. In 2008, they were producing 10 million tons of sunflower. By 2014, it's over 22 million tons. Now, why are the Ukraine and Russia producing all this sunflower? Well, one of the reasons is that at this point, the EU is using huge amounts of their own rapeseed for biodiesel. Now, EU consumers won't turn to soybean oil because it's from imported soybeans that are GM. They can't use palm oil because it's saturated and they won't use it as a dining oil, so they need to find a new edible oil. And the Ukraine and Russia react to these price signals and start producing vast volumes of sunflower oil for this new demand. The same way, as we see on the right, the rapeseed oil demand from biodiesel creates extra demand, the production goes up. But of course, with production rising, the premium comes down. And in fact, if we go back here, I told you sun oil was a premium oil. You'll see that Ukraine and Russia have been so good at producing this that today, if you look at the, what is that, blackish line, the sun oil line, sunflower oil is cheaper than soybean oil or rapeseed oil. They have removed the premium by responding so effectively to the incentives by the high prices. Well, what has this meant for soft oils? Well, it's meant they've had to find new markets. What we've plotted here is in blue, is the sunflower oil over crude palm oil ratio in India, alongside imports of sunflower oil into India. And what you can see there is that in India as well, as in the rest of the world, the sunflower oil price has collapsed compared to the crude palm oil price. And what this has meant is that India, a very, very price-sensitive market, has become a major importer of sunflower oil. Sunflower oil has been pricing itself into markets where it's never been before as a result of the low prices. Now, what about soybeans? Well, soybeans have seen a similar situation, where large demand for soybeans has really shifted the position of the producers. So what we've plotted here is the share of soybean produced in the northern and southern hemisphere. You can see that in the 90s, it was really the US, it was the northern hemisphere that was the most important producer, and their share has declined as Argentina and Brazil have come in and started producing vast volumes of soybeans, meeting the high prices. But the prices are no longer high. Brazil, in order to produce soybeans, has had to move ever further into the interior, where there are high transportation costs, there are high costs of setting up, and as a result of that, they are a relatively high-cost producer. Now, when prices were high, that didn't really matter. What we've plotted here is the gross margin for soybean and maize. Incidentally, soybeans are often double-cropped with maize. The Brazilian farmer is very lucky. They can do a short crop of soybeans and then get a safrinha, which is the diminutive form of safra, the harvest crop of maize. So both are quite relevant to the Brazilian farmer. And that's helped defray the high costs of expansion. But if you look today, so the gross margins in the reals per hectare, 2012, 2011 were high enough. With the low prices, they've collapsed close to zero. It's hardly worth planting now on the frontiers of agriculture anymore. And in fact, we predict you're going to see some adjustments here in the near future, because it will be either input use or it'll be lower planting, because essentially the premium that was there to continue to expand agriculture onto these frontiers has disappeared. Overall, though, demand for soybeans is likely to continue. And there's really one important driver for this, and that is China. So what we've plotted here in blue are the Chinese imports of soybeans. Now, the Chinese prefer to import soybeans. They don't want to import the meal. They want to import the soybeans. They want to crush them domestically and then use the meal for their livestock industry. And you can see from practically no imports, there's been a stratospheric growth in Chinese imports of soybeans. As Jack was saying, the Chinese have moved away from the idea of self-sufficiency, and they're happy to purchase soybeans, but they want to purchase the bean. Now, if we take the last 10 years of growth, the last 14 years of growth, and it's about 10% growth rate, and we project that forwards, this will show you where Chinese imports are meant to be heading. Now, you might say, will China continue to require the same amount of meal? Well, certainly there's been a slowing in the demand. We've seen a slowing in the demand for vegetable oil in China, but with more meat consumption, meal consumption really has been going up. And while there was a very quick growth when a lot of farms moved from backyard farming and from backyard pig rearing onto sort of industrialized farms, that is likely to continue. The problem for China is that if China continues to import at this rate, they're going to run out of soybeans. We've plotted alongside to this the US, Brazil, and Argentinian exportable surplus. So all of the exports coming from US, Brazil, and Argentina in green. And you can see that it's not growing as quickly as the Chinese demand is. And by 2024, or whatever that is, you're going to end up in a point where China's trying to import more soybeans than these three countries are actually exporting. What does that mean for China? What does it mean for soybeans? Well, one thing it means is that if we're right and you continue to look at higher meal demand growth, that graph I was showing you earlier, where the oil was growing much faster than meal demand, will slow. With biodiesel policies being reduced, you're going to look at more meal demand. So it'll be healthy for soybeans. But it might not be healthy for China. They might not be able to get the soybeans anymore. If you're a Brazilian farmer on the frontier right now who's looking at a zero gross margin, you may be arguing, well, what I've got here is cheap soybeans. Why don't I start rearing chickens? And if you're looking in China, where there's been huge scandals on meat, they may well want to purchase made-in-Brazil chickens over homegrown chickens. So soybean meal we can be relatively bullish on, but we don't know how the trade picture is going to advance. You may be looking at, ultimately, soybean meal is bought for the meat, and you may be looking at the meat being exported rather than the soybeans. Now, one of the things I mentioned was that the great thing about an oilseed is you don't have to crush it. So some of you are probably wondering, well, if you don't have to crush it, why have prices come collapsing down? Why are they not just holding on to soybean stocks? Why are the oil prices down? Well, the fact of the matter is we've had high harvests 2 years for a row in the Black Sea. And so there's an awful lot of people who are short on cash who needed to crush for sunflower, for rapeseed, for all these products. The other point is, as I said, meal demand has been growing quickly, and you crush the soybeans, which are 80% meal for the meal. And you inadvertently get the soybean oil as a byproduct. So you're getting that soybean oil coming into the market regardless. But there's another interesting point. In North America, we've seen lots of crushing. And this has been driven by very interesting, and in fact Jack mentioned this, by the transportation infrastructure problems there. So what we've plotted here is in Canada, these are the share of rail cars. And on the bottom, you've got the grain and oilseed share, so they're transporting agricultural commodities. And on the top, you've got the oil share, which is crude oil coming from the Athabasca oil sands, coming from the tight oil production, which has been booming in the interior of Canada. And you can see that the oil share has been increasing rapidly, much to the detriment of the grain and oilseed share. There's not enough capacity on the rails. Now, added to that, you've got some of the most fantastic grain harvests you've ever seen. You've got one of the highest canola harvests you've ever seen, and you've got the coldest winter in 35 years. There's been a huge problem transporting canola from Saskatchewan, from the interior of Canada, to the export ports at Vancouver. And so on the right, what you can see here is the ending stocks on farms, the canola that's gathering on farms. And you'll see it's a record. They've never had it this high. Simply, the difficulties in the logistics has meant that huge amounts of canola have gathered on farm. This is meant for prices. Well, what we've done here, you see, I said that Canada, the US has had a similar problem. The US has a much vaunted infrastructure that's been sort of the envy of everyone, really, but it too needs investment. And so, with the same problems with North Dakota producing huge amounts of tight oil that's taking up the rail capacity, with investments since Warren Buffett bought BNSF, which have closed down large parts, and with problems on the Mississippi, where the locks really require renovation, the Americans have also had difficulties moving their soybean harvest. And what we've plotted here is the basis. So the difference for the US in soybean prices in Chicago versus the Gulf. And as you can see, for a long period, it's pretty flat. In the same way, we've plotted the Canadian canola basis, so the difference between canola prices at Saskatoon in Saskatchewan and the export prices at Vancouver. And for most of the time, it's pretty flat. It's around $40, $60. It just reflects the cost of transportation. But ever since these infrastructure problems, you've seen the price shoot up. And what's interesting here is there's quite a distinction between the way Canada's done this and the way the US have done it. You can see the US rail prices, higher rail prices meant that the basis increased gradually. It was very hard to shift. There was no space on the rails. They couldn't get it out. The reason for that is that in the US there's a free market for rail. The fares just increased. Canada restricts the prices you can charge for rail fares for agricultural commodities. And as a result, you have a situation where everyone was waiting for the harvest to come in. They're looking nervously, anxiously at how much is the harvest going to be. It turns out to be a great harvest. Suddenly they realize they're not going to be able to move. They can't even pay more to move the canola because there are fixed rail tariffs. And so as a result, in Canada, you get a sudden jump in the basis. And what all of this means is that in the interior, for soybeans in the US and in the interior for canola for Canada, it's very cheap. And so well-placed crushers have been crushing away, making a fortune out of it. And this is one of the reasons why you've seen additional supplies coming onto the market. Where does this put us in the EU? Well, the EU hasn't had the same problem with crushing, but we have got a hangover from the amount of production. So what we've plotted here is rapeseed oil in millions of tons. That's the disappearance, so that's the demand for rapeseed oil. And then we've plotted the supply, but we've also taken into account oil and seed. So the rape seeds that haven't been crushed, and we've calculated how much oil would that be if you did crush them, to give you a fair comparison of the volumes available. So this isn't actually the amount of oil produced, it's the amount of oil that's there. And you can see early on, 2009 to 2011, supply was running less quickly than disappearance. The market was tight. Since 2012, we've had increasing production and slowing mandates, with the result that today in 2014, we're looking at disappearances way below the availability of rapeseed. And what this means is that you have a huge... Now, some of this will be crushed and possibly exported cheaply, but you will have huge stocks remaining. And those huge stocks will continue to affect the market as we go forwards into the next year. So what does this mean overall? Well, I hope I've managed to convince you that really if you want to look at vegetable oils, you have to start with the crude oil price. And that the unanticipated consequences of EU and US biodiesel policy have really altered the market, fundamentally. Vegetable oil is now part of the petroleum complex. But those changes are here to stay. It's shifting towards Southeast Asia, it's shifting towards places where it's cheap feedstock, but the knowledge that was gained in how to use biodiesel as a fuel is there. And it's what we rely on now to take excess vegetable oils off the market. But just as the markets reacted to the signals provided by our governments, provided by our policy, so they are now reacting to the excess production. And we're seeing this already on the frontiers in Brazil. We're seeing this in application of fertilizers on oil palm plantations. We're seeing a gradual coming back of production. But it won't be in the short term because we've still got an awful lot left to work through. Thank you very much.
Thank you very much indeed, Julian. You covered a phenomenal amount. I'm not sure my brain's quite absorbed all of that much information. Quick questions. We've got a few minutes before we go for a coffee break. Has anyone got some questions? Looking for hands, please. Far left-hand corner, please. Microphone.
Thank you, Chairman. Andrew Moyer, a HCCA board member and grower in Scotland. What do you think of the sustainability of the palm oil in Indonesia, Malaysia, etc.? If that's not sustainable, which I suspect it isn't, how will that affect the market over the next 5-10 years?
Well, there's two issues there, really. The one is, when you say sustainability, I told you 25% of additional vegetable oil has been required by biodiesel. Now, if you wanted to produce that based on soybeans, if you wanted to produce that based on rapeseed, think of the vast areas of the world you would have to cover. Palm oil produces 4 tons of oil per hectare. It's a huge amount of oil compared to any of the other sources. So in terms of sustainability, if we are looking to use vegetable oil as biodiesel, then actually palm oil in a sense is a sustainable solution. Now, on the plantations themselves, the issue of sustainability has reached, it's right now, it's the topic they will talk about. And in fact, what we're seeing is, with pressure from end users, we're seeing an awful lot of work being done on sustainability, on completely sustainable value chains, which are segregated. And most of the big producers, it's not worth their while to get into trouble about palm oil. They are creating segregated value chains. And I think actually there will be a large amount of sustainable palm oil, of certified sustainable palm oil, available on the market in the next five years or so.
Any other questions before we move on for some coffee? Look, I think everyone's one in the middle and then we'll move on.
Yes, Charles Blakey, just wondering about the impact of the fracking gas on the demand for oil in general, particularly in the States, because of its competitiveness.
Sorry, the demand for what?
I wondered what gas you said for a moment. I couldn't quite interpret that. It was fracking gas, wasn't it?
The ladies present.
Sorry, could you repeat that? Sorry,
the impact of the availability of fracking gas over the demand for oil in general.
Okay, yeah. That's what's going on in the background here. When I say you start with the crude oil price, look at where the crude oil price has been going. It's part of the weakness in the vegetable oil market is the crude oil price has been coming down, and an awful lot of that has been the result of this additional supply coming on in the US and in Canada. And you've got the shipping of the actual oil that they're taking out of the wells, and then you've got the US switching to gas wherever it is possible. So New York taxis now run on gas. They're trying to hook up entire cities to gas. It's reducing consumption. The big question was, how will Saudi Arabia react? And Saudi Arabia seemed unwilling to lose market share. They're not cutting back production, and that's what's causing the crude oil price to come down. And so I think, we've been saying this for a long time, and increasingly people are now coming around to this, that really the crude oil price, there's no fundamental reason to believe it should be quite this high. And it's coming down. And of course that will have ultimately big repercussions for the vegetable oil market.
Thank you very much indeed. That's something to ponder. Are we going to have a fix of caffeine? Please, thank you very much indeed. Julian,
thank you.
Great presentation. Thank you.